Hello everyone and welcome to another episode of Finding the Balance. I am Walina Denard, the creator of Life and Money, where we talk about life and money with the hope of helping you find the balance. If you are a first time viewer, thank you so much for tuning into my channel. And if you are a returning viewer, thank you so much for taking the time out to join me again for another episode. If you watched my last video, then you know that in the last video I talked about what to consider when you were selecting a savings account, but that savings account was for a more liquid sort of savings like a emergency fund or a travel fund or a revolving savings account. But in this video, I want to focus on a more long-term saving and investing account, your retirement savings account. Our parents and generations before us had the option and luxury to depend on a good pension and Social Security for retirement. However, we may not be so fortunate. With fewer and fewer employers offering pensions, Social Security is not being enough to cover, the rising cost of living, rising healthcare costs, and the fact that we are living much longer, we need to make saving for retirement a priority. So with that being said, in this video, I want to cover 3 typical retirement saving options: your 401k, your individual retirement account, and your health savings account. And if you follow me on Instagram, then you know that I opened up the floor for questions. And in this video, I'm going to be answering those questions about retirement. Also, if you follow me on Instagram, then you know that this is going to be a 2-part video. The first being retirement saving options for the employed, and the second being retirement saving options for the self-employed or small business owners. So again, if you want to hear about 401ks, IRAs, and HSAs, please stay tuned. So in today's video, I'm going to be using my iPad to kind of keep up with all the things that I want to say to make sure I'm not missing anything. Also, these videos, I try to keep them around 8 to 10 minutes at most, but this one may be a little longer because it is so much information to cover. Because for each of the 3 options, I'm going to cover what they are, the tax treatment when you're saving, the tax treatment during retirement, what happens if you take out before you're supposed to. I'm going to be covering employer matches, contribution limits, and so many things for each of the topics. So it's going to be a little bit lengthy, but let's just get right into it. So the first one is a 401k. So what is a 401k? A 401k is a qualified employer-sponsored retirement savings plan. And with a 401k, as an employee, you get to elect how much money you want to be automatically deducted from your paycheck. And this amount can be a percentage of your income or a fixed amount. So you can decide that you want to get 6% of your income deducted, or you can decide that you want to deduct $250 every paycheck. It's up to you. And there are 2 types of 401ks. The first being a traditional 401k, and the second being a Roth 401k. And the difference between the 2, the major difference is the timing of the tax benefit. So with a traditional 401k, you contribute pre-tax dollars, and your money grows in the account and earns, return from the market on a tax-deferred basis. And once you reach retirement age and you begin taking distributions from your retirement account, you then pay taxes on that money. With a Roth 401k, you are contributing post-tax dollars, which means before you pay money into your 401k, you've already paid Uncle Sam. And so you accumulate money, you earn money in this Roth 401k, and when you reach retirement, because you've already paid taxes on that money, you don't have to pay taxes on your distributions during your retirement years. One benefit over the traditional versus Roth IRA, and people compare them all the time, but one thing to know about the traditional 401k is that the traditional 401k gives you a tax savings now. So because you are contributing pre-tax dollars, you get to lower your tax liability for the current year. Meaning, say if you made $50,000, but over the course of the year you contributed $5,000 to your 401k, when you are preparing your tax return, you don't report $50,000 income, you report $45,000, meaning your tax liability is lower because you are reporting a lower amount of income on your tax filing. So employer matches. Depending on the terms of your employer's plan, a lot of employers will match their employees' contribution. Some employers will match 50 cents on every dollar that you contribute. Other employers will match dollar for dollar of what you contribute up to a certain percentage. I mean, the typical match is, 50 cents for every dollar you contribute up to about 6%. and some, contribute dollar for dollar up to about 3%. The key word here is up to. So if your match is, say, dollar for dollar up to 3%, but you only contribute 1.5%, they're going to only match 1.5%. So you lose out on free money if you don't contribute up to your employer match. So that is key. Contribution limits for the year. So for 2018, for both a traditional and a Roth 401k, the contribution limit is $18,500. And if you are 50 years or older, you get to contribute an additional $6,000 for a total contribution of $24,500. In the event that you contribute more than the allowed limit for the year, and this is, increases year to year, but for this year, $18,500, if you contribute more than that, you could be facing a double taxation. I'll try to explain this best way I can. So if you, for some reason, contribute more than $18,500 and you don't realize it before the tax filing deadline of April 15th, if you don't call your plan administrator and say, hey, I contributed too much money, I need a refund, you will be double taxed. If you realize it before April 15th and you get a refund, you only pay money on the taxes when you file your taxes for that year. But if you don't realize before April 15th, you will have to pay tax on that over contribution or excess deferral in the year that you made the contribution, and you will have to pay taxes on that money in the year that you receive the refund for the excess contribution or excess deferral. So just beware of that. Just kind of keep tabs on how much you're contributing. And most times, this is not really an issue because, the plan administrator kind of has processes in place to prevent this. But let's say you move from one job to another during the year. It will be more so your job to make sure that you are contributing according to the IRS limit of $18,500 for the year. Because the two jobs aren't going to keep track of that for you. There's no way that they really could. So, where am I? Sorry, I padlocked. So, distributions. So, for both the traditional and Roth 401k, you are allowed to begin taking money out of your account at age 59 and a half. And an exception to this rule is if you retire at 55. So, if you're working for an employer and you say, I'm going to retire now, you can begin taking distributions from your retirement at age 55. But sometimes people, they dig into their nest egg before the allowed age of 59 and a half. And if they do, 9 times out of 10, they'll have to pay taxes on the money that they've taken out and a penalty on the money. You would basically have to, say if you take out $3,000, you would have to include that $3,000 in your income when you are preparing your tax filing, and also pay a 10% penalty for early withdrawal of that money. And there are 2 ways to kind of take money out of a 401k, one being a loan and the other being a withdrawal. So the withdrawal, you will pay the taxes on the money when you file and the 10% penalty. With a loan, you can take a loan from your 401k at the amount of 50% of your vested account balance or $50,000, whichever is less. So basically the cap is $50,000, and you can take that out and you have to repay that loan over 5 years plus interest. But if you leave your job before that loan is repaid, you will have to repay the loan by the tax filing deadline of April 15th, or count the remaining outstanding loan balance as income in your tax filing. So that is distributions. For required minimum distribution, so although you're not typically allowed to begin taking money out of your 401k until age 59 and a half, you have to take money out of your retirement account at age 70 and a half unless you are still employed with the employer who is sponsoring that plan. So if you don't take your required minimum distributions or RMDs, you will be taxed. And I mean, it's a heavy penalty. So say your RMD is supposed to be $5,000. and you don't take it out and you aren't employed with the employer who's sponsoring that plan, you would have to pay a 50% penalty on the amount that you were supposed to take out. So $2,500 will go straight to the government because you did not take out the amount of RMD that you were supposed to. So now we've gotten to our first question. The first question is, should I withdraw from my 401k to purchase my first home? My initial answer, like the first thing that comes to my mind is no, because there are so many first-time home buyer programs out there, and your retirement saving is for just that, retirement. So if you can avoid it, do not take money out of your retirement account if you can avoid it. See what other options are out there. My second notion, though, is to say if you have to take money out of your 401k, take a loan instead of a withdrawal. 9 times out of 10, they don't make it easy to take just withdrawal. It's called a hardship withdrawal. You have to meet these certain criteria, and a home purchase is not really a hardship criteria. Also, in order to take a hardship withdrawal, most plans require that you take a loan first. So again, if you have to take money out of your 401k, take a loan from your 401k. But with that being said, if you're going to take a loan from your 401k, you have to be able to pay back your new mortgage and the amount that you've borrowed plus interest from your 401k. So make sure you can afford those two together. Because although it's a loan, you are required to pay that money back over the course of 5 years. I mean, and it's better than, I guess, borrowing, from somewhere else to get, the down payment together, because you're basically paying yourself back plus interest. But money that is not in a 401k account can't grow. So you could be costing yourself, tens of thousands of dollars by taking money out of your 401k over time, because that money is not in the account, not earning interest, not earning money, not growing. So again, it's not the best scenario, but if you have to take a loan, make sure that you can pay it back, in addition to your new mortgage, and make sure that for whatever reason, if you decided to leave that job, that you had the money to pay that loan back by the tax filing deadline. The next question is, what is a good percentage to contribute, a good starting percentage to contribute to your 401k? And that is the easy one, the employer match. So if your employer matches up to 6%, contribute 6%. If your employer matches up to 8%, contribute 8%. You do not want to leave that free money on the table. And of course, if you can contribute more than 6 or 8% of whatever the employer match is, please do so. Experts recommend that you contribute 10 to 15%. But a good starting point, your first job, you don't have a lot of money to contribute to retirement, contribute up to the employer match. So that is 401k. So moving on to IRA. So IRA, what is an IRA? An IRA is an individual retirement account set up at a financial institution to save for retirement. It has tax savings, and your money grows on a tax-deferred basis. And unlike a 401k, an IRA does not need to be sponsored by an employer. You can literally walk into a bank and say, I want to start an IRA, and you can do so. Like a 401k, there are 2 types of IRAs, a traditional and a Roth. And again, the difference between the two is the timing of the tax benefit. So a traditional IRA, you are contributing pre-tax dollars. With a Roth IRA, you are contributing post-tax dollars. So the contribution limits for a traditional IRA and Roth IRA are $5,500 for the year 2018. And if you are 50 years or older, you can contribute an additional $1,000 for a total contribution of $6,500. However, with a Roth IRA, there are income limits on the amount that you can contribute. So depending on your tax filing status, you may not be able to contribute to a Roth IRA. For the year 2018, I want to say if you are a single filer who makes $135,000 or more, you cannot contribute to a Roth IRA. if you are a single filer who makes, I want to say, $120,000 to $134,999, the amount that you can contribute is kind of like reduced or limited. Anyone making 120 or less can contribute the full $5,500. For a traditional IRA, anyone at any income level can contribute, but the amount that you are allowed to deduct on your tax filing is reduced depending on your tax filing and income level. So, with contribution limits at $5,500, if you contribute too much to your IRA, you will be subject to a 6% tax penalty. You can correct it and put the over contribution on your current year tax return, pay the penalty, and move forward. If you don't correct it in the year, you will be subject to that penalty each and every year that this issue remains unrectified. Distributions for an IRA, sorry, not 401k, IRA. Like a 401k though, you are allowed to begin taking distributions from your traditional and Roth IRA at age 59 and a half. If you take money out though of your traditional or Roth IRA, you may be subject to tax and a penalty. For a Roth IRA, you can take money out. You can take the money that you contributed out at any time, but if you take money out that are, I guess, a part of the earnings, that are a part of the earnings, you have to pay a early withdrawal penalty. For a traditional IRA, again, all of it is pre-tax, so if you take it out early, you have to pay a tax and a penalty. Of course, there are exceptions to this rule. You can take money out, both the traditional and a Roth IRA, for certain reasons, like you can take up to $10,000 out penalty-free for your first-time home purchase. You can take money out penalty-free for medical expenses above a certain percentage of your income. You can take it out if you are totally disabled. You can take money out of your IRA before the 59 and a half if you want to pay for education costs. So there are certain exceptions to the 59 and a half rule for both a traditional and a Roth IRA. And like a 401k, for both a traditional and a Roth IRA, you are required to take distributions from your IRA account at age 70 and a half, and you will be taxed if you do not do so. So the first question related to IRA is, when managing your Roth IRA, what are the contribution limits and how can I maximize savings? Well, the contribution limits for a person 50 and under is $5,500, both for a traditional and a Roth IRA. In regard to maximizing savings, I mean just making sure that your portfolio is diversified, and if you need help doing so, talking to an advisor and making sure you are getting the most out of your IRA savings. Question 2, should you save on top of your 401k for retirement? Although this is a 401k question, I included it here because an IRA is a great way to save in addition to your 401k. So say if you have, money you want to contribute above and beyond the $18,500 for your 401k, an IRA is a great way to contribute additional money. Or say if you only want to contribute up to your employer match via a 401k, you can also contribute money to a Roth IRA. So the contribution limits for a 401k don't apply. Let me take that back. You can contribute to a 401k and an IRA. So you can contribute $18,500 to your 401k and the $5,500 to your IRA. So IRA is a great way to save in addition to your 401k account. So that is IRA. We are going to move on to a health savings. So now let's talk about the health savings account, or HSA. For those employees who are enrolled in a high deductible health plan, you have the option to contribute to a health savings account. And when most people think of an HSA, they think of an account that allows you to pay for out-of-pocket expenses as they arise. But people really don't understand how an HSA can be a benefit in retirement, but it is a great option to save for retirement. So, according to a Fidelity study, a couple age 65 in 2018 will pay approximately $280,000 after tax for medical costs. That means, health insurance, medical expenses. So, a HSA is a way that you can save money to pay for those costs during retirement, those very high costs during retirement. One of the greatest benefits about an HSA is the triple tax benefit. So as you are contributing money to the HSA, you're contributing on a pre-tax basis, which means you put money in pre-tax, you get to reduce your current year tax liability. So that's savings one. The money grows and earns on a tax deferred or tax free basis. Then you get to retirement and you can take the money out to pay for qualified medical expenses without paying tax on the money. So you get a triple tax benefit from an HSA. Also, you can invest money in an HSA. So you can have a cash account and an investment account within your HSA. And you can invest in mutual funds, stocks, bonds, just the same way you would invest for an IRA or a 401k. So not only do you have the triple tax benefit, you also have the ability to earn a little money on your contributions. So for 2018, the contribution limits for an employee enrolled in a self-only HDHP or high deductible health plan, the contribution limit is $3,450, and for an employee enrolled in a family HDHP, the contribution limit is $6,900. Anyone over the age of 55 can contribute an additional $1,000. And please note that unlike the 401k and IRA, that limit, that $3,450 and that $6,900 includes your employer matches, if any. So let's say your employer contributes $1,000 to your HSA. If you're enrolled in a self-only HDHP, you can only contribute $2,450 to your HSA. If you are enrolled in a family HDHP, you can only contribute $5,900 to your HSA, because your contributions and your employer contributions are calculated or considered when you're thinking about the limit, the contribution limit. So this is an example to kind of show you how great an HSA can be for retirement. So let's take a 25-year-old who is enrolled in a self-only HDHP and decides to contribute to an HSA. He or she contributes the max of $3,450, and they use about $1,000 in medical expenses each year. So each year they leave $2,450 in the account. And this HSA, they decide to invest, and they earn a average of 8% return on the money each year. That's what the average rate of return is. After 40 years of saving in this HSA account and still using $1,000 to pay for out-of-pocket medical expenses, this account will have accumulated $635,000. That is a great nest egg to put money into, to store money into, in addition to your 401k and your IRAs. And that can be used just for medical expenses. So let's talk about distributions during retirement for HSA. So distributions, like I said, when you're in your retirement, distributions are penalty-free and tax-free as long as you make those distributions to pay for qualified medical expenses. And you can do that, as you're saving, and once you retire, you can continually take money out as these medical expenses arises. But the penalty part changes once you reach age 25. So if you, not 25, 65. Once you reach age 65, you can take money out of your HSA for any reason and not, be assessed a penalty. You will still have to pay taxes on the money, but you will be penalty free. And I think the penalty is 20% if you take money out of your HSA to pay for non-qualified medical expenses. So again, this is a great, savings vehicle to have in addition to your 401k and your IRA, because this money can be used tax-free to pay for all those, high health care premiums and long-term care premiums, medicine, doctor visits, everything can come out of this account as it relates to medical expenses. So you won't ever have to touch your 401k, your IRA for that reason. And in regard to required minimum distributions, for your HSA, there are none. You don't have to take money out ever. You can leave it in that account forever. I mean, of course, we don't live forever, but there are no RMDs. So you won't be penalized if you don't take out the right amount or take out an amount when you retire. So that is all I have for you today. This video covered 401ks, IRAs, HSAs, you know, the tax treatment when you're saving, the tax treatment when you're in retirement, employer contributions, employer match, basically all the key elements when you're thinking about a 401k, IRA, and HSA. Hopefully it was helpful and informative. Hopefully it has encouraged someone to start, you know, saving for retirement if you haven't already been doing so. And as always, if you like this video, please hit the like button. And, you know, to keep up with what's going on in this channel, please hit the subscribe button. Tell your friends about the video so they can, you know, view and subscribe. If you have any questions, comments, feedback, please feel free to drop a comment below. I mean, I welcome your questions and your comments and your feedback. Again, I want this to be a community where you share, I share. If you have any questions, if I didn't touch on something the way that you wanted me to, just please let me know. Or if you have, you know, if you want to talk about non-typical retirement options, drop a comment. You know, thank you for watching, and I will see you guys at the next video. Take care.